So what is the S&P 500 index, and why does legendary investor Warren Buffett recommend investing in it? In 2008, Warren Buffett issued a challenge to the hedge fund industry. His $1 million bet was that an S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years. Protege Partners LLC accepted it, and with all of their glossy brochures and pictures of guys in suits to make you think they're smarter than you, the hedge fund manager turned in the towel. Buffett won. The bet put two philosophies against each other: passive and active investing. Hi, I'm the Business Guy. And with this totally free info, I just ask you to please click the like button below so YouTube will promote this video. Thanks very much. And on this channel, we do our best to get right to the point, give you tons of value in little time. So please click the subscribe button below so that when more videos come out like this, you'll get notified. In fact, I practice what I preach. By putting just a little aside each month, I built a multi-million-dollar stock market portfolio for my wife and myself, and I'll show you exactly how you can become a stock market millionaire too, even if you have a very small income. In my case, I prefer to keep my investments in a secure offshore asset protection trust with a secure offshore brokerage account to protect from lawsuits. After all, that's what I and our team of attorneys and consultants do for a living. We set up asset protection trusts for our clients. By the way, you can give us a call if you want more details. So I'm going to tell you why I focus most of my retirement investing that I've accumulated over the past 30 plus years for my family, and why one of the most respected investors in the world, Warren Buffett, also recommends investing in S&P 500 index funds. Now, the S&P 500 or Standard & Poor's 500 index consists of most of the 500 largest publicly traded companies in the U.S. based on the market capitalization or total value of all of the stock in each company. The market capitalization of a company is calculated by the price of one share of stock in the company times the number of shares that company has issued. It's not an exact list of the top 500 most valuable U.S. companies by market cap, because there are other things they need to have in order to be included in the index. That's why Tesla, with its huge market cap, wasn't put on the list right away. They need some staying power, so it's not just a flash in the pan, and now Tesla is part of the index. Many professional investors see the S&P 500 index as the best measuring stick to compare the results of other investments. Other U.S. common stock market benchmarks include the Dow Jones Industrial Average, or Dow 30, that measures the performance of the 30 large companies from various industries that are listed on stock exchanges in the U.S., and the Russell 2000 Index. Okay, what is that? Well, first I have to tell you about the Russell 3000 Index, a larger index of 3,000 publicly traded companies that represent nearly 98% of the value of the U.S. investable stock market. Now, Russell excludes stocks trading below $1, as well as stocks that trade on the pink sheets and OTC bulletin board. The Russell 2000 Index is made up of the bottom two-thirds or smaller companies of the Russell 3000 Index. Okay, so what is an index fund? An index fund is a type of mutual fund, and a mutual fund is a pool of money from the investing public where money managers use that money to buy other securities, usually stocks and bonds, or an exchange-traded fund, ETF, which is basically a mutual fund that can be purchased on the stock exchange just like a regular stock. Either of these two types of index funds generally has a portfolio of stock that follow a market index such as the S&P 500. An index fund can provide broad market exposure, so if one company goes out of business, you have 499 other companies giving the index stability. It has low operating expenses because you're not paying a money manager to sit there and pick stock all day, and low portfolio turnover, so it's also tax efficient. Now, these funds follow the index regardless of market conditions. You can call Charles Schwab, Vanguard, Fidelity Investments, or if you want to protect yourself from lawsuits, you can call us at the number below and we can set up an offshore brokerage account in a secure offshore company and trust. So when somebody sues you, nobody can easily yank your hard-earned money out of your account like they can back home. In fact, lawsuits are the biggest threat to the U.S. person's wealth. Now, index funds are generally considered ideal for the person who does not pick stocks on a full-time basis, which makes them great for individual retirement accounts, IRAs, and 401ks. Now, that's the reason why Warren Buffett consistently recommends index funds as a place to put your money rather than picking individual stocks. He says it makes sense for the average investor to buy all of the S&P 500 companies at the low cost that an index fund offers. So why not pick individual stocks? Well, let's go ahead and take a helicopter view to answer that question. Okay, now first, let's look at the largest companies in the world in the 1980s. We see on the list IBM, AT&T, Exxon, Standard Oil, Schlumberger, whatever that is, Shell, the oil company, Mobil, Atlantic Richfield, General Electric, and Eastman Kodak. Okay, now let's compare that to today. This is a screenshot I just took of the world's largest companies. We see Apple, Saudi Aramco, Microsoft, Amazon, Alphabet, Facebook, Tencent, Berkshire Hathaway, Alibaba, and Tesla. Do you see any of the 1980 companies here on that list? I don't even see one. Let's go ahead and take a wider view and look at the top 20 companies today. Do you see any of those companies on this list from 1980 on this list from today? I don't even see one, not even one. Okay, so how many of the top 10 companies from 1990 are still on the list today? You see NTT, that's Japan, Bank of Tokyo, Mitsubishi, a lot of Japanese companies in 1990. These are the largest companies in the world. We don't even see one company on the list today that was on the list in 1990. Okay, how about the year 2000? How many of the top 10 companies from 2000 are still on the list today? I see Walmart and I see Microsoft. Okay, how about 2010? I see Walmart, I see Apple, and I see Microsoft. I remember in 1997, back before Steve Jobs came back, Apple was almost bankrupt. They were on the verge of death until Steve Jobs' iMac G3 came along and saved the day, and then the iPod and finally the iPhone. Now, based on that background, it's your turn. Let's go ahead and take a look at the list and tell me which of these companies will still be in the top 20 in 30 years. Go ahead. How about 20 years? Go ahead. Which ones? I have not a clue. Not a clue in the world that someone won't come up with a better electric car and drive Tesla to its knees. I have no idea if Facebook will become another MySpace that died a sudden death. I thought nobody with their market dominance and the number of stores that a retailer could knock Walmart off its perch. The number one retailer. How could they? Then came along Amazon and IBM in the 1980s. I thought, how could anybody ever beat them in the computer game? So how do you become a millionaire? By investing in the S&P 500. Okay, since you asked, here's a plan. Say you're a librarian or a janitor and you make only $3,333 a month. That's $39,996 a year. Now, you probably make more than that. You probably make a lot more than that, but let's go ahead and start there. You invest 15% of your income, or $500 a month, into an S&P 500 index fund. Let's see how that's done over the past 30 years. Okay, this example is a little more than 30 years. This is when my wife and I got married in December of 1988. So let's go ahead and take a look and see how that's done over that period of time until today. The total return for the S&P 500 has been 1,374%. That's an annualized return of 8.6%, and with dividends reinvested, that's an average annual return of 10.96%, say over the past 30 plus years. Okay, so let's make a plan on how you specifically can become a stock market millionaire with just a meager income. Okay, let's say you make your $3,333 a month, and you probably make a whole lot more than that, and you invest 15% of that, which is only $500 a month, into an S&P 500 index fund. At 10% interest per year, like we said, is very reasonable, like we showed above. After 30 years, your results will be $1,031,000. That's how you can become a stock market millionaire. Now watch, only 17% of that amount is the money that you invested. 83% is the interest that you gained on your money by the increasing value of the S&P 500 index. So that's a specific plan as an example of what you can do if you want to become a stock market millionaire. So why the S&P 500? Number one, they're more likely to bounce back from market downturns. The S&P 500 index fund tracks the S&P 500, which is seen to represent the stock market as a whole. That means if the overall stock market is doing well, your S&P 500 index fund will do well also. Of course, this also means that if stock market goes down, your index fund will likely go down as well. But because the market has always recovered from every downturn it's ever experienced, there's a very good chance your investments will also bounce back too. Like one wise investor told me when I was 22 years old, look at the man walking up the stairs, not the yo-yo in his hand. So that's why we looked at the long-term big picture a bit ago We don't focus on the daily fluctuations. We look at the trend, and the trend has gone up over the past 100 years. Number two, they're smart investments for people on a budget. Why? Index funds are one of the most affordable investment options available, making them an excellent option whether someone does or does not have piles of spare cash. Somebody may just be focused on paying the bills, but still may want to invest for retirement. So even if you only have a few dollars to spare, you can throw that into an S&P 500 index fund and then sit back and let it grow. Number three, they provide immediate diversification. When you invest in an S&P 500 index fund, you're actually investing in 500 different stocks at once. So that diversification really lowers your risk, because if a few of those investments don't perform well, it won't tank your entire portfolio. So is an S&P 500 index fund right for you? Well, none of this is investment advice. After all, I'm just some guy on YouTube. But if you're looking to invest in the stock market while limiting your risk, my experience is that you can't go wrong with an S&P 500 index fund. They're also great for those who prefer a hands-off approach to investing, because you don't need to research which stocks to invest in or decide which ones to buy and sell. But if you want to take a more active role in your investing journey, there may be other options that are a better fit. The option you choose will depend on your personal preference and finding the right type of investment that will make savings for the future much easier. But for me and my millions, hey, I've got a business to run. I like to sleep well at night. I prefer a secure offshore asset protection trust with a secure offshore brokerage to protect it from lawsuits, and I'm going to focus primarily on S&P 500 index funds. Please click like below, subscribe, and share this video with friends and family. Thanks for watching. This is The Business Guy.